Welcome to Financial Decisions. In this section, we'll be discussing a number of issues related to financing. First, we'll discuss capital structure. We'll discuss the choice of financing through short-term or long-term debt facilities. And then finally, we'll talk about financing your operations. Understand that our approach here to financing is a very basic approach. Really, it's focused on the decisions that upper management need to take. How much debt do I have in my firm? What's the proportion of debt to equity? Should I finance it using bank loans, or should I finance my operations or my assets using bonds? These are essential issues that we'll be talking about over the next few minutes. First, financing structure. What's important here is to understand that organizations have basically two ways to finance their business: through debt or through equity. Most businesses start off with equity financing. That's to say, the shareholders investing money in the firm to buy equipment, buy materials, pay for employees, pay for research and development, or for whatever else. However, when equity is insufficient, ownership, management can turn to debt financing. And then a combination of debt and equity arise within an organization or firm. So you have a choice of financing. And what's related to that choice is a proportion with which you will finance your firm. How much will be debt? How much will be equity? The second implication of your financing choices or your capital structure is the implications for your WACC. WACC is a weighted average cost of capital, and we'll talk about this in the next couple of slides. And then finally, default risk. Default risk is associated with having too much debt and not being able to finance it. So there's two ways you can look at default risk. One, there's too much debt with respect to equity. So your debt to equity ratio or your debt to total capital is very high. On the other hand, your debt to equity ratio may be very high, but if debt is very, very cheap, the cost of financing it, the cash flow that is required to pay for your interest, might not be very significant. So on one hand, you have the amount of debt that appears on the balance sheet, and on the second hand, you have the interest that you need to pay for and the reimbursement of that debt at one point. When debt is cheap, when interest rates are low, there's an interest of having more debt within an organization. When interest rates are high, debt becomes a much more precarious choice. What is value? Now, if we want to look at a firm like we look at a house is financed in a couple of ways. You have your initial down payment, the equity that you put into the home, and then you have the rest of the purchase price financed through debt or a mortgage. Firms are not very different than that. In a firm, we will finance initially with equity, or we can have additional financing rounds with equity, and we can also finance with debt, either bank debt or bonds through financial markets. So, what is the cost of the equity and what is the cost of the debt? So the cost of equity is essentially a formula based on the capital asset pricing model. Essentially what the cost of equity is the return required by shareholders. And that return is based on the risk-free rate. The risk-free rate is the interest charged by the government for lending out money. Usually 10, 20, 30, 40-year bonds are used as the benchmark to determine the risk-free rate. The market premium, how much more do you get by investing in equities than you would over investing in debt? And then you have two other risks that are considered: industry risk and firm risk. And those are usually captured by the beta of the stock. And the beta essentially is the risk associated with holding that particular stock with respect to the market. So if the beta equals 1, that means the risk associated with a stock is equivalent or moves in the same way, that is the gains and the losses, as the general stock market. If the beta of a stock is 2, that means for every 10% movement in the price of the market, this particular stock will move 20%. So if it goes up by 10%, your stock, if the market goes up by 10%, your stock will go up by 20%. If the market goes down by 10%, your stock will go down by 20%. So there's a higher risk reward associated with a higher beta. On the other hand, a very low beta means regardless of what that market does, there'll be very little movement with respect to the value of your stock. Now, low beta stocks are generally associated with utilities, stable cash flows, low growth industries that are predictable and safe. High beta stocks are generally associated with high-tech industries, high risk, new ventures, new industries, new sectors. Something around a beta of 1 generally reflects the risk associated with the market. The cost of debt, on the other hand, and why debt is of interest as a financing tool, is because of its tax shield. We'll get to that into a second. So the risk-free rate is, that we mentioned before, the rate associated with a government lending out bonds. Now, as a firm, you have more risk than the government of Canada. So if you are a firm operating in Canada, it is assumed that the government of Canada is a much more secure investment. That is, the bonds issued by the government of Canada are going to be cheaper and more likely to be repaid than any other firm within Canada. Okay, that's not always true in a lot of other countries, where sometimes you have firms that can actually be quoted better than the government. But that's not a discussion for today. And then finally, with the cost of debt, we have the risk-free rate, and then we have the firm risk. And firm risk is based on two basic elements. There are more, but we'll just focus on 2. One, the level of indebtedness of the firm. So as the firm becomes more and more indebted, the cost associated with financing that leverage, and leverage is a word that describes debt or indebtedness, the riskier the firm is. So the cost of the interest rate will go up. The other risk associated with having debt on your books is the financing risk, right? So the more debt you have, the more interest you have to pay, the more of the cash flows that it eats up. And that risk is associated really with the stability of the cash flows. So if you have a stable cash flow, you're likely not going to have a big risk associated with repayment debt. Okay. If you're interested in learning more about the cost of debt and the risks associated with debt or indebtedness, I suggest you read a seminal paper by Miller and Modigliani that talk about the benefits and dangers of debt. Now, what is the weighted average cost of capital? The weighted average cost of capital essentially looks at 2 things. It looks at the cost of equity and the cost of debt, and the percentage of each within a firm. So, and we always look at the after-tax cost of debt. Why do we look at the after-tax cost of debt? Because the actual interest that we end up paying, although it might say a 10% bond coupon, so you have to pay 10% at every coupon, 10% per year, we actually pay less than that because we're allowed to deduct the interest expense from our taxes. So the real cost of debt for our firm is the interest rate adjusted for the taxes. But we'll get into that in a second. So the weighted average cost of capital is the percentage of equity within the firm. So equity divided by the debt plus the equity, which is the total capital, times the cost of equity. And this is derived from the capital asset pricing model. We won't get too much into that today. Plus debt divided by debt plus equity, which is the total capital. So this is the same amount here, times the cost of the debt, right? Adjusted for 1 minus the taxes, because the actual cost of the debt is, let's say your taxes are 40%. So your actual cost of debt is 60% of whatever the interest rate is. So if the interest rate here is 10% and your tax rate is 40%, your true cost of debt is 6%, not 10%. So Miller-Modigliani suggests that as your cost of debt increases, the cost associated with that debt will also increase because of bankruptcy risk. Okay, so let's take a look at the weighted average cost of capital with respect to this graph. So there is a right-sized or optimal capital structure of debt to total capitalization where your weighted average cost of capital is minimized. And this is the capital structure that a firm should be targeting. Now, make sure to understand that the weighted average cost of capital and this debt to total capitalization, or your indebtedness, will vary from firm to firm because of different betas, because of different costs of debt, because of different costs of equity, and this not only for within a country, but across different countries. So if you go beyond this optimal capital structure, so if your debt to total capitalization begins to increase, that is primarily due to the fact that your cost of debt begins to increase rapidly because of the risk of bankruptcy. So you end up becoming a more and more riskier firm to invest in with respect to your debt. And because your risk of bankruptcy increases, your cost of equity actually begins to increase as well. Because if you're going to more likely to be bankrupt, then the likelihood of a shareholder gaining back their funds is actually less. In this next section, we'll talk about financing structure.